Welcome back to Investing Talk Podcast.
Today we're looking at AST SpaceMobile.
As usual, before we start, subscribe, like, and comment to this video to support the show. Now, we are looking at something that feels like it was ripped straight out of a science fiction novel, aren't we?
Oh, absolutely.
This isn't just another satellite internet play. We are talking about a company that has captured, the imagination of retail investors and the skepticism of Wall Street in almost equal measure.
You are so right. AST SpaceMobile, ticker ASTS, is, well, it's arguably one of the most ambitious tech plays on the market right now.
It really is.
And I want to be clear right off the bat. We aren't talking about beaming internet to a dish on your roof like Starlink. We're talking about a $30 billion bet on direct-to-phone cellular broadband.
No dishes, no pucks.
No dongles, nothing. Just your standard smartphone connecting directly to a satellite in space. It's the holy grail of connectivity.
It's a massive vision, I'll give you that. It's the kind of thing that just changes how the world works if they can pull it off. But my job is to be the buzzkill and look at the price tag.
Of course.
And right now, the math is, well, it's intense. We're looking at a company trading at a sky-high valuation, burning cash, and banking on execution that has to be, flawless.
Mm-hmm.
So the question we're answering today is simple. Is this the next tech giant connecting the unconnected? Or is this a price for perfection bubble that's one launch delay away from bursting?
That is the tension that defines this stock, 100%. But if you look at the growth, you can see why the market is troughing at the mouth. Let's look at the revenue trajectory first.
Okay.
We just got the numbers for Q3 2025, and hypergrowth is really the only word for it. They hit $14.74 million in revenue for the quarter.
$14 million.
Now, I know that might sound small in absolute terms for a public company, but year over year, that is a 1,236% increase.
Okay. Over 1,000% growth is impressive on paper. I won't take that away from them, but we have to contextualize that, right? The trailing 12-month revenue is still just, $18.5 million?
It is.
For a company valued in the billions, that is a tiny sliver of actual cash coming in the door. It's like a lemonade stand suddenly selling champagne growth percentage, but the total volume is still really low.
I see the analogy.
And if we look at the bottom line, the picture gets much darker. EPS earnings per share was negative 45 cents in Q3. They missed estimates significantly.
I knew you'd bring that up.
Well, yeah. We're talking about a trailing 12-month net loss of over $300 million.
I always go straight for the earnings miss.
I have to. The net margin is negative 1,600%. Think about what that actually means for every dollar they bring in.
They're spending $16 to get it.
Exactly. That is a heavy, heavy burn rate. You can't sustain that forever.
It is a heavy burn, I agree. But you have to look at the trend line, not just the snapshot.
Yeah.
We are seeing a bullish inflection here. Yes, they're losing money, but the losses are narrowing.
Okay, explain.
The Q3 2025 loss was around $122 million. Compare that to the previous year where they lost roughly $171 million.
This is coming down.
It's a significant tightening. It shows that as they scale, they're moving down the cost curve.
Moving down the cost curve. Explain that for the listeners who don't spend their lives in Excel sheets.
Sure. Basically, the first satellite you build is incredibly expensive because you're figuring it all out. You're building the factory, the tools.
It's R&D.
All of it. The second one is cheaper. By the time you're building the 50th, you have an assembly line. They are getting more efficient at spending money. They aren't just lighting cash on fire. They're building valid infrastructure that gets cheaper to replicate.
Fair point on the narrowing losses. And I will admit, when I looked at the balance sheet, I expected a disaster given that burn rate. But it's actually surprisingly robust. You could even call it a fortress balance sheet for a company that's pre-profit. They're sitting on over $1 billion in cash.
Exactly. That gives them a massive runway. In this industry, cash is oxygen. If you run out, you die.
And they are breathing easy for now. Their debt to equity is conservative at 0.43. But here's the number that really stood out to me. Their liquidity ratios, quick and current, are near 9.5.
Which is just, it's almost unheard of for a growth company.
It is. To translate that, For every dollar of bill or debt they have due in the next year, they have $9.50 in the bank to pay it.
So no solvency issues.
None. They aren't living paycheck to paycheck. They have a war chest.
Yeah.
They are not going bankrupt tomorrow. However, we have to mention where that cash came from.
Dilution.
Dilution. The share count exploded from around 148 million to 272 million. They nearly doubled the share count. They sliced the pizza into way more slices.
They did. But context matters here. They didn't dilute out of desperation because they couldn't pay the light bill. They raised that capital at high valuations to fund aggressive expansion. That is smart management.
You think so?
I do. If the market is willing to give you billions for your equity, you take it to build your moat. And that capital is funding their competitive moat, which is what really sets them apart.
The killer app, so to speak.
Right. Everyone compares them to Starlink because they both involve satellites, but it's apples and oranges. Starlink requires a ground terminal, that $500 dish you have to set up. AST SpaceMobile connects directly to standard 4G and 5G phones.
Zero friction for the user.
Exactly. You don't buy new hardware, you don't carry a puck, you just walk outside.
It essentially turns a cell tower into something that orbits the planet.
Precisely. And that leads to the partnership angle. Because they don't need proprietary hardware, they can partner with existing mobile operators like AT&T or Verizon.
So they're not a competitor.
They aren't trying to steal customers from the telcos. They are becoming a value add for the telcos. That creates a network effect. As they launch more satellites, the coverage improves, the service becomes more valuable, and they lock in that premium enterprise market. It's a B2B model that is much more defensible.
I can see the argument there. It's a cleaner path to market adoption if the tech works at scale. You aren't fighting for every single customer. You're just turning on a tap for millions of them at once. But a great story doesn't always equal a great stock price.
True.
We need to see if investors are actually buying into this vision. Let's pivot to the charts and see what the price action is telling us.
All right, the momentum here is, well, it's undeniable. If you held this stock through 2025, you are very happy right now.
Oh, yeah.
The stock gained over 240% last year. And even into 2026, it's up another 24% year to date. That is serious relative strength.
But it hasn't been a straight line up, has it? This is not a stock for the faint of heart. We regularly see double-digit pullbacks, 10, 12, 14% drops in a matter of days.
It's a volatile.
It whipsaws. But you are right. The trend is up. Currently, it is trading above both the 50-day moving average at 84.88 and the 200-day at 67.77.
And for those new to technicals, trading above the 200-day is generally the definition of a long-term bull market. It means the average price over the last year is trending upward.
Technically, that's a bullish alignment, but looking at the support levels, where's the floor? If this thing drops, where does it land?
Analysts are flagging strong support around $76. That seems to be the line in the sand where buyers step back in. Every time it dips near there, it just gets scooped up.
Speaking of getting scooped up, let's talk about who is actually buying, because this isn't just retail traders on Reddit anymore, is it?
No, this is the smart money story now. The institutional flow is staggering. Over the last 12 months, we have seen 341 institutional buyers, we're talking hedge funds, pension funds, the big guys, pour in $2.04 billion.
$2 billion.
Compare that to the sellers. Only 113 institutions sold, taking out about $325 million. That's a 10-to-1 ratio favoring accumulation.
That is a huge signal.
The big funds are loading up.
That is a strong signal, I can't deny that. When BlackRock or Vanguard starts buying, you pay attention. But I have to play devil's advocate here.
Go for it.
If the smart money is buying, why are the insiders selling? We saw $164 million sold by insiders in just the last 90 days.
I knew you'd focus on that.
I have to. If they are so confident in the moonshot, why are they cashing out? If I truly believed my company was about to become the next Google, I wouldn't be selling $160 million worth of stock right before the launch.
I think that's a bit unfair, though. Look at the rally. The stock is up 240%. If you were sitting on those kinds of gains, you'd take some profit, too. Executives have mortgages and college tuition, just like everyone else. It looks like standard portfolio management to me, not a lack of faith. The selling is tiny compared to the institutional buying.
Perhaps. But insider selling is always a yellow flag for me. Let's shift gears to how the broader market is feeling.
Sure. We are seeing a bit of a disconnect here. I describe the market mood as, I guess, mixed to neutral with bullish undertones. It's a battleground.
That's a polite way of putting it.
Yeah.
Feels like a brawl. If you look at the analyst consensus, it's actually pretty grim. The general rating is a reduce. We have 3 buys, 5 holds, and 4 sells.
Right.
And the price targets imply significant downside from here. Wall Street analysts are looking at the valuation and getting vertigo.
Well, they're fixated on the current numbers, not the future potential.
Mm.
Analysts build these, discounted cash flow models, spreadsheets that look at today's earnings and project them forward.
And those models break with a company like this.
They break. And the news cycle is giving the bulls plenty of ammo. We just had the successful deployment of Bluebird 6. That was a massive validation of the technology.
That was a key win, definitely. It proved the satellites work in orbit as advertised. It moved the conversation from can they do it to can they scale it.
Exactly. And then there's the SHIELD program, the defense validation. That opens up a whole potential revenue stream from the government.
And government revenue is the best kind of revenue. It's sticky, it's reliable.
The check's always clear. Plus, the launch schedule is aggressive.
Yeah.
They are planning to deploy 45 to 60 satellites by the end of 2026. If they hit that, the capacity skyrockets. The revenue spigot turns on.
Iphicreus is doing a lot of heavy lifting in that sentence. And that disconnect you mentioned between the skeptical analysts and the buying institutions, that's the whole issue, isn't it?
It is. Wall Street is doing the math on today, while the institutions are betting on 2028.
It's a timeline arbitrage.
That's a great way to put it.
Well, let's look at what could derail that timeline. We have to take off the rose-colored glasses. Let's pivot to the risks. With a valuation this high, the fall can be incredibly painful.
Well, there are definitely risks. This isn't a savings account. Lay it on me.
Risk number 1 is simple: execution and delays. They have a history here. They already missed their original 2025 targets. And right now, the immediate worry is the Q1 2026 goal. They targeted 5 orbital launches. We are approaching the deadline, and by my count, they still need 3 more launches by March 31st.
It's a tight window, no doubt. Space is hard. Weather happens. Rockets get scrubbed.
It's extremely tight. If they miss that Q1 target, it's not just a schedule slip, it's a credibility hit. The entire $30 billion valuation is tied to that goal of having 45 to 60 satellites up by the end of the year.
I hear you.
If they start slipping, the revenue projections for 2027 push to the right. And when you do that on a high-growth stock, the stock price corrects sharply.
But is a delay of a few weeks really catastrophic for a long-term play? If the tech works, does it matter if it arrives in April instead of March?
When you are priced at perfection, yes. Yes, it does. Which brings me to risk number 2, valuation and dilution. Let's hammer the numbers. They are trading at 1,600 times revenue.
1,600.
1,600x. Their market cap is bouncing between 30 and 45 billion against 18.5 million in revenue. That is astronomical. Even for a tech stock, that is nosebleed territory.
It's a growth multiple. You can't value a pre-revenue infrastructure play on trailing sales. You're pricing in the future cash flows of a global telecom utility.
But you also can't ignore the cash burn. Launching satellites is incredibly expensive. Yes, they have $1 billion in cash, but to get 60 satellites up, the burn rate is going to remain immense.
Which means?
It means the risk of further dilution is high. If they have to raise more cash, existing shareholders get watered down again. Your slice of the pizza gets smaller.
I admit, the valuation is scary if you look at it through a traditional lens, and dilution is a real risk. But here is the mitigation. Delays are likely weeks, not years. SpaceX is a reliable launch partner. And regarding the valuation, if they hit that revenue inflection in the second half of 2026, the multiple compresses naturally. Revenue will skyrocket once the commercial service turns on. We are looking at a J-curve.
So the bet is that revenue grows faster than the share count.
Exactly. It's a race, and right now, the technology is winning.
All right, let's wrap this up with a verdict. We've looked at the hypergrowth, the massive losses, the fortress balance sheet, the technicals. We've seen the institutions buying and the insiders selling. What's the final score?
I'm giving AST SpaceMobile a bullish score of 7.5 out of 10.
7.5. That's pretty high for a company with negative earnings and negative margins.
It is, but hear me out. This is a speculative moonshot. I'm not saying put your retirement fund in this. It is high risk, high reward.
Right.
But the technology is validated. Bluebird 6 proved that. The institutional backing is massive. $2 billion doesn't lie. The valuation is scary, yes, but the upside, if they become the global standard, it's just massive. We are talking about connecting 3 billion unconnected people.
The TAM is the entire planet.
The entire planet.
So what's the time frame on this?
This is a 2 to 3 year hold. Do not buy this expecting to flip it next week. You have to ride out the volatility. You have to have the stomach for those 20% drops.
And for the strategy, if someone is listening and wants to get in, what do they do?
Do not chase this price.
Yeah,
The stock is extended. It's had a massive run.
agreed. My advice on entry, wait for a pullback. We mentioned that strong support at $76. If it dips to that level, the risk-reward ratio looks a lot better. Don't FOMO in at the top.
And keep the position sizing small. We're talking 2 to 3% of your portfolio max. Treat it like an option call that doesn't expire.
I like that analogy.
If it goes to 0, you lose 2%. If it goes to the moon, you make a significant return.
It's a binary outcome play. Either they connect the world and it's a 10-bagger, or the tech fails to scale and it goes to 0. There is very little middle ground here.
That's the game we play. 7.5 out of 10, but buckle up.
Absolutely. Well, that's all we have time for today on AST SpaceMobile, a fascinating company with a lot of hurdles left to clear, but a vision that is undeniably powerful.
Thanks for tuning in. Remember, high risk, high reward.
And as always, subscribe, like, and comment to support the show. We'll see you on the next one.